Welcome to the Bangers Only podcast, where Tom Lydon and his band of experts make money talk exciting. Here's your host, Tom Lydon.
Welcome to the Bangers Only podcast. Life is short. We've got to keep things simple. Use your time to focus on what's most important to you. That's what Bangers Only is all about. I'm Tom Lydon, and with me today is Brittany Christensen, and she's head of business development at Tidal Financial. Brittany, welcome. I'm so happy that you're joining me.
Thanks for having me, Tom.
So, Brittany, before we get started, and this is going to be a very educational investment type podcast, but talk a little bit about Tidal. And this is a fairly new company, but you've had huge success.
Yeah, thank you. So we are an ETF white label firm that focuses on helping emerging managers or new managers or existing managers enter the ETF space. The ETF space historically comes with significant barriers to entry, as most folks would think about it. And those barriers to entry can become a little easier if you decide to outsource some of the infrastructure to a company like Tidal. So there's a lot of rules, there's a lot of regulations. I think that the US ETF might be one of the most regulated financial products, if not the most in the world. And so we really focus with helping our clients build ETF as a complementary aspect to their business and unlock shareholder value through tax efficiency. We currently manage over 250 ETFs with roughly 45 billion in assets across the suite. Lots of different flavors to choose from because typically our clients bring us the idea and then we help them package it up.
Yeah, and what you do is provide an unbelievably positive service. Okay, so ETFs, exchange traded funds, many people own them, many people have heard about them. Many people who have been investing for a while might have bought individual stocks over time. They might have bought mutual funds over time. The ETFs are a form of fund, but just the next evolution. And when you think about the ETF space and how quickly it's grown, it's not as big as the mutual fund space, but it's going to give its mutual funds a run for their money, don't you think?
Absolutely, I do. So think of ETFs as the evolution or the 2.0 version of a mutual fund. They actually were created by mistake, right? Or by accident, maybe not by mistake, but without intention. It became a more tax efficient opportunity for investors to still invest in a pool. And so that is the innovation that mutual funds brought to market, I think over 100 years ago, right? When we saw the first mutual funds created. And so think of this as its sort of 30-year-old version 2, if you want to think of it that way. ETFs offer greater flexibility for the investor. And as we see, a more computer-based world than we obviously lived in 100 years ago, that's one of the natural reasons why you're seeing ETFs sort of take over from a growth perspective against the mutual fund space.
Yeah, and if you're an investor and you bought mutual funds, you know that you can buy them on your major brokerage platforms. The difference is you buy them and they settle at the end of the day. So you get that end of day closing price when you buy it or you sell it. With exchange traded funds or ETFs, they operate on an exchange and you can buy them in the morning and sell them in the afternoon. And there's a bid and ask and that whole thing. It trades more like a stock. So for many investors who have grown up with mutual funds or buying individual stocks, it's kind of the combination of both. And most importantly, as you bring out, there's some tax efficiencies involved. Back in 1993, when the first U.S. ETF came out, the S&P Spider S&P 500 ETF, SPY, like you said, it was kind of a mistake, but it was an opportunity to buy the S&P 500, the one single ticker. Since then, this evolution of index-based strategies has exploded. But today, since most of that landscape has been gobbled up in the index world, many active managers who've been successful over time, whether you're a small advisor and you have a kind of a cool idea that you'd like to bring to market in the form of an ETF, or you're an established global asset manager with tens of billions of dollars, you can do that. And both of those types of clients are your clients at Tidal, correct?
That's correct. I like to kind of liken it to, we might have been a relatively new company, but we were definitely in the right place at the right time, creating our sort of white label business as the ETF rule was being passed, right? And so the ETF rule, for many who don't know, was passed in 2019. So we've been talking about an industry that's about 30 years old, but then the ETF active ecosystem is even younger than that. And so the regulatory changes that happened just before the pandemic really opened it up to make it much easier for an active manager to come into the ETF wrapper. And so we focus a lot with those types of clients running active strategies, as it's generally a part of the ecosystem that hasn't quite matured. That's probably where most of the growth opportunity sits.
So it's gotten easier, especially from a regulatory standpoint. But as you pointed out earlier, there is a lot of regulatory responsibility when you get into the marketplace. And that's where you folks come in. You help with that regulatory plumbing. You also help with the trading. You help with the registration. You help with the active management through the capital markets services that you offer. And then most importantly, if I'm an active manager and I have been managing money, whether it's in the form of individual stocks or model portfolios, or even a mutual fund, I can bring that program to you and you can put that nicely tucked into an ETF wrapper, do all that plumbing, make me look good, and most importantly, offer a new and more modern package to individual investors and advisors, correct?
That's correct. Typically, our clients have sort of two main jobs that we will not help them with. One of those jobs is to be the portfolio manager. So, how is the fund getting invested? What securities will it hold? And when will it transition in and out of those securities? Some funds use an index as a baseline and have an active overlay of decision making to evaluate what's underneath that. Other managers are fully active and make those decisions day by day as they go through, obviously different volatility periods in the markets. Um, as a white label platform, we allow them to focus on that job and then being the face of their product, right? The portfolio manager out there telling people where this fits into their portfolio, when an investor should utilize this type of strategy, and how it's different than the growing competitor landscape of the ETF world. One of the things that I think often people sort of appreciate from an investor perspective, as an investor in an ETF, it should be highly regulated. Everyone can buy these, right? And so it should follow a very strict set of guidelines and standards, so that all investors are treated equally. And that is one of the aspects that's sort of inherent in the ETF, let's call it lifeblood, that is our industry, that we live and breathe transparency, but we also live and breathe kind of doing the right thing equally for all shareholders.
Yeah. So you're bringing up something that I think is important to talk about. Ease of access today is paramount. And anybody who really wants to get into the ETF space, working with you, or even if they want to do it all independently, they can. However, there are recent reports that are actually more ETFs than individual stocks on the exchanges today. And the question begs, do we really need that many ETFs? As more and more asset managers are coming to you, are they all different? Are they all going to be successful? And you and I look at the league tables on a regular basis. There are some of for example, the big three, the Vanguard, the Fidelities of the world, the State Streets of the world that are commanding still the lion's share of the assets. There are also some mid-range ETF companies that are coming up. But boy, on the bottom of the list every week, there are more asset managers entering the business. What are the prospects for them in the future?
Yeah, I mean, listen, growing an ETF is not easy work. And that's usually where most of our conversations start, is how are we going to be successful in doing this? Or you're just going to, hate everything in 3 years and shut the fund down. Most funds will die within the first 2 years. And so what we see across the industry is, on average, our open to closure rate has actually gotten better. So there's a 3 opening ETFs to 1 closure ETFs ratio that's kind of persisted through 25. 24 saw closer to 2 to 1. So sort of a 50% chance of success. If you want to think about it as, I want to start an ETF, I got a 50% chance it's going to live past this 2-year mark. Many investors look at these things, want to understand a new active manager's performance. It's been normalized by obviously all those regulations and rules we talked about. So once it's in an ETF, I think, from an investor perspective, I'm really looking at how viable is this fund and where does it fit in my strategy? And if they're an active, untested manager, I might wait a little longer to see how they perform in different market environments.
Yeah,
Um, as someone who's guiding someone who's maybe launched an ETF that isn't doing so well, you really have to kind of start to think about, I mean, even before you launch the product is something that we really focus on. What problem is this solving? Who are you building this for? Is there a captive audience that's ready to invest alongside you? Do you think you have a new and unique idea that hasn't been done before? New and unique ideas, obviously, as the industry grows, become more rare, as expected. But I think your question that you started with, are there too many ETFs? Did anybody ever ask that about the mutual fund business? Because you don't often hear that talked about, right? And there are way more mutual funds than there are currently ETFs. One of the benefits I actually see is that the ETF business will naturally weed out some of those players over time, over that sort of 2-year period. It is a very expensive business to run. So if you're not in the green, there's going to be a period of time where you just can't keep funding the bleed. And so I think that many people that we speak to, we're really focusing on what is your path to getting to that break even so that you can make sure that you're actually doing something that's worthwhile, worth your time, and also going to bring a beneficial product to the market and not just add another aspect to it.
absolutely. And look, you mentioned innovation's key. The cool thing is we continue to have great innovation. You think about areas of the market like inverse and leverage, the single stock ETFs, the synthetic income area is exploding. Talk about crypto and how that's continued to boom as well. And active managers are coming to market with nuances that maybe we haven't seen before. We're thinking about private equity, private income that's also coming into the space as well. So it's not like we're losing out on ideas. We continue to see new ideas, but not every ETF that comes to market is going to be successful. Okay, so we want to talk about taxes. Look, it's been a great few years. It's been a great 10 years for the market, especially here in the US. When you think about mutual funds and taxation, and you think about ETFs and taxation, it's different. Not just the day to day and the creation redemption process, which we're not going to go down that hole, but there is in the mutual fund world an aspect where if you generate capital gains within your mutual fund portfolio as a manager, 90% of those have to be passed on to shareholders by the end of the year. And if you've been a mutual fund shareholder, you've probably received this holiday gift in the form of a dividend that you have to pay taxes on that you may not have been expecting. So this is also more prevalent as we're seeing the competition in the ETF space start to nip away at the heels of the mutual fund world, where some mutual funds that maybe for decades were very successful and continue to grow in assets are actually getting net redemptions. And what's happening is, as people are leaving this mutual fund, the fund manager is having to sell low cost basis stock, generating a gain, and that gain is then passed on to those shareholders who happen to be consistent and stick around. Talk about that if you would.
Absolutely. So I think one of the interesting things in thinking about any pooled fund vehicle is that the nature of it is that you're pooling your buying power together for ultimately, hopefully, a better outcome, right? And so being a part of a mutual fund, being part of an ETF, you're sort of a group of investors together that increases kind of your pricing power, right? And so presumably when people start to leave the group, which is what we're kind of starting to see happen in the mutual fund space, that has an impact to the people who are still left in the group, right? And so sometimes if I even break it down in that kind of simple context, you might be holding a mutual fund that's been in your account for ages. Now we've come off of the heels of a very extended bull market. Most of the losses in the broader portfolio have been harvested, right, over the years to minimize any other taxable gains that they manifested. But as investors leave the group, that forces a function within the mutual fund structure of this redemption that you mentioned, right? So you might even have a year where, let's say, the performance of the fund is not looking great, and somehow I still got a capital gains distribution. The performance of the fund and your specific investments is all based on your timeline. If investors are leaving the fund, forcing the fund to actually sell some of its assets to satisfy the redeem, that is what has triggered the gain within the fund that is now impacting the remaining investors. So I think
I'm not happy either. I'm barking that I don't want to have to pay that year-end capital gain, especially on a down year. And that's really key and critical here. I mean, I think we're in a situation where a lot of investors and specifically advisors, Brittany, are making that decision to say, look, I've got other choices. And I don't want to, as we're especially coming on towards the end of the year, do I want to stick around? Most mutual funds do the right thing and they post whether an estimate on what they think their year-end distribution is going to be. Now, they don't do a great job with that. And some services like Morningstar will also help with that. But boy, if you are not doing that great in that fund comparably to the market, and all of a sudden there's a post that a big distribution might be coming, you kind of want to think about heading for the hills, right?
That's right. You do. Nobody wants the taxable distribution, despite the fact that that generally means that you invested with someone who did what they told you they were going to do and helped your money grow. Obviously, you want that to be beating the benchmarks, but it is an ironic problem that most money managers say, oh, if I do my job too well, then I'm going to trip everybody with these taxes. So it's a bit of an issue, which the ETF obviously helps solve for, right?
Yeah.
It was very well designed in the sense that it offers the flexibility to a manager to make a decision to trade in and out of something that he no longer believes in while he's still in a gain. And it offers the deferral mechanism for an investor to not be, one, impacted by other redeeming actions that happen in the ETF, and then two, not have to deal with, portfolio rebalance activity triggering gains because you're letting the portfolio manager rebalance while he's still won on that name, right? He's still achieved appreciation, so he can kind of lock that in and then rotate into his next best idea.
Right. Okay. So the bottom line here is it's nice when the market's moving up and that your funds are performing, but it's not about solely what you make. It's about what you keep. And
That's right.
some smart investor said that decades ago. And I think, especially in these markets, people are thinking that. So, with that in mind, the industry has taken it upon themselves to say we might be able to do something different. So, the advantages an exchange traded fund has is great. And now there's the ability to actually transfer assets in a mutual fund to an ETF or model portfolios. And the model portfolios are a big thing. Many advisors have model portfolios. I heard a statistic that half of the money in BlackRock's iShares ETFs are actually in model portfolios, but they suffered the same thing.
Yeah.
They have tax burdens that ultimately get passed on to their clients too. So, with this 351 IRS rule, explain this for somebody like me with a little pea brain, what this actually means and what the advantages would be with doing that type of exchange.
No problem. So 351 is part of the IRS tax code. And it has been leveraged for various other things in the past, contributing assets to a company, a new formed company, as a startup.
Real estate, right?
Real estate has happened, right? Exactly. So there's many times where maybe a wealthy individual has come across the 351 transaction before. The use case into an ETF is slightly different and maybe a little bit new. So this is an individual or a manager or a fund manager contributing existing assets, what we call in kind, to the ETF. In kind essentially meaning I'm giving you a basket of groceries and you're going to give me back something that represents the full basket of groceries, the value of the full basket of groceries. And it's going to basically track up and down based on the value of those groceries over time, right? And so I'm sort of exchanging what I owned in my individual apple and banana and all the things here, and I'm giving it to you to give me.
What about Reese's?
Reese's is in there. So I gave the peanut butter and the chocolate, and I got the Reese's in return. That would be an example of an in-kind transaction. So those are the types of things that really the ETF takes advantage of. It's all about this in-kind redemption. It's sort of the second way that a fund can either take in assets or remove assets from its portfolio by just accepting the assets that it intends to hold or expelling the assets that it already holds. This is not seen as a sell or a trade between two entities because it's a like for like transaction, which is essentially how it's classified differently from a tax perspective. So what we're seeing in the industry is twofold. It hits on some of the points we talked about in the first part of the interview. Launching a new ETF is hard. Being successful in the market is hard. Finding enough assets to come to market with break even is hard. So now you have the issuer group problem statement clarified. Move now to someone who has a bunch of securities that have all appreciated. Maybe they don't want as much exposure to the Mag 7 as the world changes, but they feel like they're handcuffed to those positions. They can't do anything about getting out of them. So this is where those two problem sets really find a nice happy home where everybody can be benefiting from this type of transaction. The investor can contribute their appreciated securities to the ETF. The ETF can gather assets to help it start its journey in the ETF competitive terradome, we like to call it in the industry, right? And give them a better leg up as far as covering a lot of the embedded costs of running the ETF. So it's finding those right overlaps, and there's a lot of different rules in the way. That's where a partner like Tidal as an ETF team of experts would come to really help flesh that out. You can imagine that if you're trying to marry very antiquated and legacy code from the 1940 Advisors Act, which is what governs most of the ETF world, alongside the legacy code of the 351 exemption in the tax code, you're going to have times where you need a lot of lawyers to marry together those interpretations. And we're sort of obviously living through that right now as a trend. But it is something that people should be aware of, and maybe also be, have your little, if it sounds too good to be true, most of the time it isn't the case, right, Tom? Like we hear that all throughout our whole lives. There's some instances here where this might be one of those things where it does seem too good to be true, and it is actually true. Maybe there's some things to make sure that you're just checking the box on to make sure you're not getting, pulled into something that you didn't appreciate you were getting pulled into.
So, Brittany, the bottom line here is there's $20 trillion in mutual funds. And many of these mutual funds, especially those that have done well, have embedded gains that at one point in time, the IRS is going to enjoy taxes from those gains as those gains are passed on to their shareholders in the form of distributions. Why the heck would they allow this to happen?
It's a great point. And I think one of the things is that we don't know. We don't know exactly that they, are fully going to allow this to happen forever. But the spirit of most of the lawyers that I have spoken with on this topic generally kind of leaves me feeling that there's so much benefit that comes out of this. It's true innovation that unlocked this tax treatment, and it currently impacts a lot of investors. So, this question usually gets broken down, I think, into two separate sections. One, the 351 is actually not the way that you would transfer the mutual fund assets over with those trillions of dollars in gains. Typically for the mutual fund, you would engage in either a full conversion or you're exploring launching an ETF share class. There's still open rules that we're waiting on from the SEC as far as how that will be governed and managed for an active manager to have an ETF class added to their mutual fund. And that will be a space to watch. We're all eagerly awaiting some guidance from the SEC on that topic. And that should provide some clarity on at least one path forward. The other path forward to convert a mutual fund is generally not very fun because it can involve a number of different things that have to happen, including sometimes shareholder approval. So most managers don't love to have to consider converting their fund. But I think at the end of the day, the taxes are still going to get paid. It's a matter of long-term, short-term, and it's a matter of deferral versus avoidance, right? So nothing in either of the application, whether you're talking about a mutual fund conversion or share class or a 351, are generally seen as avoidance strategies, right? They are deferral strategies that will basically have the end investor paying the tax when they ultimately sell out of their ETF position. They will be paying the tax of the full appreciated portfolio. for the proportion that they sold. So you're still ultimately paying the tax. So I think there's an element there that mostly the IRS gets comfortable with, that it's not an avoidance strategy. Then you have to look at the other aspect, right? The ETF itself, the wrapper itself, has embedded benefits to this in-kind redeem. And unknown to most, the redemption mechanism actually is a 40 Act rule. So most mutual funds can do this as well. However, it's just not as embedded in the day-to-day mechanical management as it is with an ETF. We don't need to go down that rabbit hole. As you mentioned, it is a complicated one, but just the fact that there are more ready and willing partners to be on the other side of an in-kind redeem from an ETF generally means that ETFs use this functionality much more frequently than a mutual fund might do. So without taking and impacting the entirety of the tax efficiency of the ETF wrapper by reworking what's going on or allowable within the 1940 Act, we as a collective industry don't really expect pressure to come down on that part of it.
Yeah. So this is great. Look, as an individual investor, and maybe you're coming across this for the first time, there's a lot going on. There's more opportunity for innovation in the space, and we've touched on that as well. Also, from a taxation standpoint, there are benefits that are coming. There will be more conversions from funds to ETFs, from model portfolios to ETFs as well. The ETF share class rule is pending, and that could have huge benefits too. And then also another version of 351, we actually have some ETF issuers that are saying, look, if you've got sizable portfolios of individual stocks with embedded gains, we can actually take your portfolio into our 351 exchange fund and diversify it so we can actually clean up some of those gains as well. I know the folks like Meb Faber over at Cambria has been successful doing that. I expect we're going to see more of those as well. So Brittany, listen, you're in a wonderful seat there at Tidal where you're on the cutting edge of helping this innovation. I think a couple things we have to touch on. Look, I'm on a couple fund boards. I'm on Guggenheim's fund board, been on there for a while. I'm also on the old Goldman Sachs ETF Accelerator board. Then Goldman decided they were no longer going to be in the white label business. We as trustees had to find a home for these two trusts. We ended up doing a lot of due diligence and ended up landing these trusts at Tidal. So hence, this kind of came to you and I getting to know each other a little bit and thinking, boy, this subject matter needs some more attention, and thus this podcast. So thank you for this, Brittany. It's been fantastic. Before we go, if someone's interested in learning more about Tidal and what you folks do, how can they get in touch with you?
Absolutely. So you can find me, source me on LinkedIn, or you can go to our website. There's a nice little form there to get introduction to our business development team, and we will speak with you about what it takes to bring an ETF to market. We are happy to have conversations, large or small. If you think you have an interesting idea, bring it to us, and we'll help guide you towards a good outcome.
Excellent. Brittany, thank you. I really appreciate it and look forward to seeing you again soon.
Thanks, Tom. Nice to be here. Have a good one.
The opinions expressed in this podcast are for informational purposes only and are not intended to provide specific investment advice. Any past performance discussed during this program is no guarantee of future results.